All right, so looks like we have everyone here. Again, I apologize for the late start, but thank you for joining today. So we are going to talk about purchasing stocks with a discount. So if you have been here with us, essentially, we have started this course, and it's the Foundational Options Strategy course, where we're going to talk through maximizing income in your portfolio. That was the first session that you attended with Tony. Now we're going to talk about utilizing cash covered puts to purchase stocks with a discount. And we'll go through that in so much detail to make sure that you fully understand it and have those foundational knowledge that you needed. Now, if you did not receive that ebook that goes through foundational knowledge, I definitely encourage that you download that. That's in your email, or if you haven't taken a look at that, a lot of the jargon that's there, we try to remove that as much as possible, is found within that ebook, because we want to make sure that you have the foundational knowledge that you need to continue with this course. So on to the income perspective. And I'm Jessica Inskip. I'm the Director of Product and Education at Options Play, have over 14 years of experience within the industry, within various brokerage firms. So really excited to join you today with this educational aspect. So of course, before we get started, I do have to give you a disclaimer. Just know that types of securities, forms, and research tools are for demonstration purposes only. There are securities that we're going to use as an example. They're not considered a solicitation or an offer to buy or sell. This video is not intended to be tax, legal, or investment planning advice. And again, illustration purposes, and all illustrations do not include any commissions or fees. And then, like I said today, this is the course schedule. So we're actually still on this first session here, where we're going through maximizing income with your portfolio, utilizing covered calls and short puts. So this first session is where we covered calls, and now we're going to go to the other side of the option chain and look at short puts and how you can generate and maximize income with short puts. And then, of course, make sure you sign up for next session, where we talk about directional profit, and then of course mindset, which is extremely important when trading in general. That one's applicable to not only just options, but trading altogether. So let's go through our agenda and what we're going to cover today. So I'm going to give you a review of options, what a short put is. We'll go into that with some detail. I'll give you an example of a short put, and we're going to compare that actually to buying stock outright directly. That way we've got a good solid foundational understanding and can apply it. We'll talk about optimal trade setup. There are some optimal environments in selling cash covered puts, especially with areas of implied volatility, which is certainly occurring now. We'll talk about our opportunities and ideas, resources that are available to you. And then of course, we'll talk about trade management, and we'll go through your questions and answers at the end. So, but the question that I want you to keep in your mind that we're going to go through is, how can I invest for the future at a discount utilizing short puts, otherwise cash covered puts? And also, I do want to bring this slide back up, and this is from Tony's presentation going through who this webinar is for. Just know that your portfolio allocation, so sometimes people think of options, and in their mind that is inclusive of active trading and very aggressive trading, and know that it certainly is a risk asset. But the way that we mitigate utilizing risk assets is via education and understanding the components and how they work. So this portfolio mock-up, for example, is 20% speculation and 80% long-term. And so this is for those looking to have a mix of that. And know that most investors, especially in my experience, who have active traded portfolios and are successful, only do that within a portion of their portfolio, not the whole thing. So the purpose of this is we want to add yield to those long-term investments that we have. So that's what we covered in the covered call webinar. Now we're going to talk about utilizing yield to purchase stocks on a discount on securities that we're bullish on. And it requires consistent rules. And this is all about consistency. And like I said, having your mind in the right mindset is also extremely important. So with further ado, let's dive in. Start with just a review of what an option is. I think that's important when we're going through foundational courses. An option is just a contract. It's a contract between a buyer and a seller. The buyer pays the premium, which means they want the contract to have as much value as possible. That's your goal as a contract buyer. So you pay that premium. the option seller, they receive that premium. And your goal from an individual basis is you don't want that contract to have any value. You don't want it to be executable upon, and you don't want it to, you essentially want it to be worthless and as quickly as possible. So we're talking about being on the seller end of that contract. So let's add a little context to that. So this contract contains the right to buy 100 shares of ABC at 100 per share, and it's executable at any time for within the next 30 days. So in order for that to have value, ABC from a put perspective, remember, if it's issued as a put, that means it contains the right to sell. A call means it contains the right to buy. So from the buyer's perspective, when this contract is issued as a put, it contains the right to sell. So therefore, for the contract to go up in value as much as possible, I need ABC to go down, because if I have the right to sell at 100 and the market is pricing it at 90 or lower, I could buy those shares on the market, immediately execute upon the terms of this contract, and make the difference. So in that case, 90 versus 110. So for this to be worthless, which is my goal as a seller, I'm on the other end, I want to keep that premium. I just need ABC to be right above 100. So literally 100.01 or higher, which means that this is a neutral to bullish position. And I can profit from being short a put if the security remains above, just or slightly above, or even moves higher. And we'll talk about the risk versus reward, but I want to make sure that we understand the mechanics of an option, specifically from the eyes of a put, and then the goals of the put seller. So the goal of the put seller is to make sure that ABC in this case, or whatever underlying security we choose, is directly above the strike price. If that makes sense for me, please type 1 into the chat. Extremely important before we move on. Definitely need some ones. See lots of ones. Perfect. Thank you so much. All right, so let's build a cash covered put. So I love to show profit and loss diagrams. I'm a very visual person, and this essentially tells me that it's bullish by looking at it, and I'll explain what I mean. So on a profit and loss diagram, this means that the stock is going up in value, and so I can see that I profit as the stock goes up in value, but my profit is capped. That's what this straight line represents, meaning if the security goes up in value beyond a point, which is right here, I can't make any more money. I won't participate in that capital appreciation. So understanding the mechanics of that is what we're going to capitalize on. This actually has a risk profile similar to owning a stock, because in the put scenario, you are the short put holder. Remember, you want the option to be worthless. Therefore, I need the stock to go up, but if it goes down in value, that's when the person who is long the put is more likely to execute. And so that happens when the stock goes down. And that is why it has a similar risk profile as owning the stock, because when I own a security and I spend about 10,000, this has the same exact amount, because whatever I spend can only go to 0, and the same occurs here. So we call that substantial loss potential. And that's why this is we'll talk about the benefits of the underlying security versus the cash covered put, but that's extremely important just to think about risk reward profiles. So let's talk about building the cash covered put. And I do see a question about the recording sending out later. Yes, the recording will be sent out later in addition to the slides. So number one, in order to build a cash covered put, it contains the obligation to buy the shares when the long put holder says, I want to go ahead and exercise the terms of this contract and sell my shares at this price. You're obligated to buy it to them at this price. They do that normally when the contract has value, which occurs when the underlying goes below the strike price. So in order for you to cover that and make sure that you have assets aside, you just have to have the cash readily available to buy the shares, which you would do anyways if you were buying the stock outright. You sell a put option and your cash becomes collateral. So you'll say, I am obligated to execute upon the terms of this contract. I'm going to buy the shares at the strike. I have this cash ready to go in order to fulfill the terms of that contract. So that's why it would not require margin in this scenario. You receive a premium utilizing that cash as collateral, which means you're generating yield on that cash in addition to whatever asset that's sitting in, but that creates the obligation to buy the stock or exchange traded fund at that specific price. So that's how we create the cash covered put, and we'll go into it in a little more detail. So now I pulled a security JM and try to give you some real prices as quickly as possible, especially with this market. Sometimes that can certainly generate a challenge. But let's talk about the risk reward and comparing this with buying a security outright versus a short put. So we talked about both there. So whenever I'm buying a stock, you are going to have an intent. So I'm going to buy 100 shares of JM at 160 in this scenario. And let's say it's trading at 165. So I'm waiting for a pullback from some type of analysis that I've done at some sort. And perhaps I have a price target of 175. So that's an entry and exit point that you've defined. You may have that or you may not. Those are important when trading options, but this is a longer term strategy. So we'll talk about that. If I were to simply put in a limit order to buy this security, I would have to set aside $16,000, so $16,000, sorry, 160 per share. That is my risk potential. And that's going to sit there until JM hits an ask price at 160. So I'm still using my cash as collateral, which is the point of giving you that example. Now, I'm setting aside, I'm willing to risk 16,000 in order to make 1,500 or 15 per share. So my profit, and so this is that visual representation, my profit from the stock perspective is unlimited because this can theoretically go to an infinite price, and my loss potential is substantial because the security can go all the way down to zero. However, my break even is 160 if it doesn't move from where it is, assuming that order executes. Now let's talk about someone who is utilizing the obligations inherent of an option to do the same thing. So in order to create this put, so we have that price target in our mind, we would sell one JM 160 put at 315. So remember, one contract represents 100 shares. So, and I'm receiving $3.15. We'll multiply that times 100 for a total of 315. So this means I'm obligated to buy 100 shares JM at 160. In exchange for that obligation, I'm receiving 315 per share. So multiplied times 100 shares. That obligation kicks in at the person who is long that contract. It's their discretion. And that normally occurs when this trade goes against me or the contract is executable, which is if JM were to be below 160. So you could see how, okay, well, if I am owning the security, that's the same risk potential I have for buying the stock anyways. That's the purpose of showing you that. However, what I have done, sorry, my mouse is going a little crazy there. From a risk perspective, since I received that premium of 315, I've reduced my risk exposure because I'm collecting cash up front. And my reward is actually maximized with the same price target of 175 because of that additional premium that I've received. So now my break-even point, I've reduced it by the amount of premium that I've received, which in this case is 315. So this is the risk here. So you may say, and often this comes up, why won't I do this every time? Well, this is a longer term strategy. And the risk for this is if JM were to skyrocket, you're not going to participate in that capital appreciation because your gain is capped right here at this point, which is actually 163.15. So if this were to go any higher, then that reduces, you're not going to make that money in that scenario. And this was where we go into strike selection, because then in your mind you say, okay, well, Jessica, I'm doing some math there. You just said 163.15, it's at 165. This is where we create optimal environments and entry points. So if we feel there will be a pullback in a security, that gives us some room for the security to move. Additionally, there's something that happens with puts and all options, but specifically puts in high volatile environments is, remember, a put contains the right to sell a security. And that's often used to hedge. So if you own a stock, sometimes you buy it as an insurance policy. And if there is fear that the market will go down, that fear makes that premium more expensive. And when something's more expensive, we don't want to buy it, we want to sell it. And so this gives us room for movement and still being profitable while reducing our risk exposure. So if you feel something is going to move up drastically, then that's when we would want to adjust our strike prices. And we'll talk about that in a little more detail in a moment. But does that make sense? If that does make sense for me, go ahead and type 2 in the chat for me. And what I want you to take away from that is substantial risk exposure equivalent to buying 100 shares. We are reducing our risk exposure by keeping a premium. However, our risk from utilizing the put versus buying the stock outright is that upward profit potential. And I see lots of 2s, so thank you for that. All right, so let's talk about optimal short puts. Now, I've pulled a different security here because I want something that perhaps is pulled bullish, and this is where we can go through the tool where you can utilize the resources that are available to you. So I pulled Swedbank here. It's showing up as bullish on the 1-month trend and on the 6-month trend, and something with technical analysis. Think of when you look at a picture. If you're zooming in on a picture on a smaller time frame, you're going to see something different versus a longer time frame. So your smaller time frame might be bearish, but your longer time frame might be bullish. However, when both match up, that indicates strength on the trend and perhaps a more optimal environment. There's more that goes into that, but that's just an indication of how those work and why I pulled that specific security. Now, I do want to do a thought experiment with you here. So from our options play back testing perspective, when we've back tested these through a lot of securities, the optimal expiration is 30 to 45 days. Now, within the first session and that ebook that we gave you, we talked about options pricing. And I alluded to that a little bit in the beginning, and I'd love to expand on that for you. When you have a contract, an options price is made up of 3 main components. And those 3 main components, we split into 2 categories. And oftentimes a question that I get the first time someone's trading options is, why is the option not moving in tandem with the underlying security or equivalent with the underlying security as much as the underlying security? And the answer to that is an options price is dependent on more than just the underlying security. It has extrinsic value components. And we talked about implied volatility for a brief moment with the mechanics of the market being volatile. Another great example of implied volatility is earnings. When earnings occur for an underlying security, we expect the security to move up or down drastically in either direction if it hits or misses expectations or gives us different forward guidance. We understand how that works. Because of the likelihood of anticipated movement, it makes the options premium more expensive. And that's an optimal selling environment. However, if there's something like earnings coming up, that also creates a risk environment, different different category that we will talk about on the next session. So we know that pricing is made up of the underlying security, implied volatility, and then the third component is time value. So the more time that you have until expiration, the more expensive it will be. Quite logical, because I have more time for that underlying security to move above or below my strike price, or in other words, my desired direction. And so that's something from an option selling perspective that's working for me, because time is a decaying asset. It's going to make that option go down in value, which means since I sold to open my contract, I can buy to close it at a much lower price. And that's why short options profit any neutral, in this case, short put, neutral to bullish environment, is because that time decay is something that I can capitalize on. And that's important to know. Whereas if you are long the option, you have to overcome that. And we'll talk about that on the next session. Now, I want to spend a little more time on time. Time is also not linear or in a straight line when it comes to time decay. So if you have an option that is very far out, so perhaps a year, as it gets closer to expiration, it slowly decays. But then when it gets to about 14 to 21 days till it expires, it actually starts falling off of a cliff, and that's rapid decay. And that's risk for someone who's long the option. But if we're short the option or short the put, that's ideal for us. And so that's why this optimal expiration is 30 to 45. It's allowing for that gradual decay, and it's so we can capitalize on that and create our position. And then we want to look at closing our position when that rapid decay begins, and we want to make sure we capitalize on that. So that's the importance of showing you that there. So from an options pricing perspective, those three components, we call it intrinsic and extrinsic value. Intrinsic value is really internal factors. So does the option have executable value? And then extrinsic value is external factors. How much time do I have left until expiration? And is there a likelihood of anticipated movement in the underlying security that's elevating my premium? So that's important to know from what comprises the price of an option contract. So now from choosing your optimal expiration, I'll provide you with a little thought experiment we love to do here. So I've chosen a 150 strike. This collects $7.20. Or excuse me, these are not in dollars. I apologize, I didn't remove that. I did pull this with the correct currency. This is a return of 4.8%. So this is 720 versus 149.70. That's where that math comes from. My break-even point, the point where I start losing money, so my reduced break-even is 142.80, and this is a 48 delta. So I want to make sure I provide you what these data points mean. A 48 delta. So if you attended the last session, we talked about delta being a lower delta means higher likelihood to expire worthless, which is the goal when we're short a contract. However, they shift depending on which side we are and what we're utilizing them for. So with that in mind, I would love to know which one you would choose: the 150 strike that collects 720, the 145 strike that selects 520, or the 140 strike that collects 380. And remember, this creates the obligation to buy the stock at this price, and I'm receiving that premium, and this is when I start losing money. So if you don't mind putting in the chat which strike price you would choose: 150, 145, or 140. See, 140, lots of 140s. Okay. 145 and a 150. Okay, leaning more towards 140. And that is expected because you probably attended the last session where we tell you to prioritize the lower delta to account for capital appreciation, because lower delta means that I'm giving myself wiggle room in this case. Now, this is where you have a choice to make, and it certainly varies with bearish environments. If your goal is to own the underlying security, then this 48 delta is actually an optimal choice, because I'm bullish on the overall on this overall position. So I want to participate in capital appreciation as quickly as possible. So my risk to the upside is, if this was to go beyond 157.20, I'm not participating in that. I would sell another contract and keep this process still collecting premium. But if my goal is to own this security, then I would choose this one. Now, if I was, my mouse does that, I apologize once more. And if I intended to have some wiggle room where I felt perhaps this security is gonna bounce back to the 145 area, then I may want to choose to give myself some wiggle room, as this is finding some resistance and perhaps is relatively close to there, in which case I would choose this delta. Otherwise, this one is we're not collecting enough premium, and we're not going to participate in that capital appreciation. So if my goal was to just not be assigned and continuously do this, then I would definitely do the lower delta. But the goal is to utilize this to purchase the stock at a discount, which means a 50 delta. So sometimes you're not going to get exact 50. So I pulled the closest. 4.8 here is going to be the optimal, because I'm going to receive 720. I still have wriggle room of 142.80. That gives me a raw return of 4.8%. And if I am assigned this security were to move below and not move above my strike price, I'm okay owning it as long as it doesn't move below 142.80. So that's the strike price selection there. But again, could be modified to be a little bit lower delta if you feel this, you want some more wiggle room to have a lower break even. But that's where it's important to know your sentiment. And that's why I started this session with a goal in mind where you felt the security was going to be. Anytime you buy a security or you're selling a short put, that's a bullish strategy. And we have to ensure that our sentiment stays in line and is evaluated, and always make calm, calculated decisions. Say that one quite often. Does that make sense? If that makes sense for me, please type A3 in the chat for me. Andreas, you are ahead of us. I love that. Thank you. Perfect. Thank you. All right. Lots of threes. So we have built a lot of tools that do the heavy lifting for you. And that was part of the reason options play was found. And excuse me. And I of course joined later after that, but that's what kind of attracted me to options play. Is I've been in options for a very long time. There's certainly a better way to visualize data. If you have ever looked at an option chain, which I'm sure you have, in order to find optimal trades, you look at the Greeks, you look at a lot of information, you do some math, and we're at an age where there's so much technology in front of us, we shouldn't have to do that anymore. So the purpose of options play is doing the heavy lifting for you. So all optionable Nordic stocks are found on this report. So they're just like you have that covered call report, there's also an optimal short put report, where we're going to give you the underlying security, days to expiration, raw return, anything that's optimal that's created. So if you don't know where to start and you just want to sell a cash covered put, this is a great place to start, because there are two ways that you'll find yourself trading options. Number one is via the underlying security. You've got a sentiment on the underlying security based on your process, whether it's technical analysis, fundamental analysis, balancing macro versus micro, hopefully a combination of all of the above. It takes some time. That's one way. The other is, like I was saying, those implied volatility moments where options are more expensive than they normally are, or an optimal environment has been created based on a variety of things based on the option and the underlying security, that's the other way that options are traded. And again, it can be a combination of both. So that's how this report is extremely helpful, is it's searching for those optimal environments and giving you the information that you need rather than you finding an underlying security and then scanning an option chain. This is the reverse, if you will. You can sort by annualized return or raw return using an indication of implied volatility. From anything higher is going to be those expensive contracts. So that's certainly helpful in this type of scenario. So I do encourage you to utilize those resources that are available to you. So let's talk about outcomes. And I think this is extremely important to talk about because we've talked about order entry and setting it up, creating optimal environments. So let's talk about what would actually happen if this was executed and what my thought process would be when we're placing these trades. So we're selling, and I switched this one to ABC, a 165 put at 485. And again, these are real prices, even though it says ABC. So if I'm selling at 165, that's what this line represents. So this is just another version of what we've talked about. This 160.15 is my break-even point because I've brought in 485. So this is what I'm reducing my risk exposure. Therefore, it's going to require this 16,000 or 16,015 in cash. Now, if ABC moves above 165 and continues to move above, the put expires worthless. That's when it doesn't have any executable value, which, remember, could absolutely be my goal. And that is the goal. We just don't want it to go beyond that 485, so 169.85. When it does, then we aren't participating in that additional capital appreciation. But that means that I could roll up and then adjust from there. So that's the importance of changing your strike prices. That's a winning scenario. So if I'm still bullish on this security and it's hit its next resistance zone or resistance point, this option is absolutely going to deplete in value if it's at, I'll call it around 170, so that 169.85, because that option contains the right to sell at 165. And if it's at 170, well, the market is a much more advantageous price. Therefore, that option depleted in value. So I could buy it back at a lower price and sell another option and still collect more premium. So that's an optimal environment and still a good outcome, even if it goes to that point. Just know that's when we have to adjust our trade. Now, let's talk about what happens if it were to move below. So we have given ourselves some wiggle room. It can move down to 160.15. And if it does, we haven't lost. We're breaking even at this point. If it moves lower, we're still going to own the security. And again, you'll own that security only if you're assigned. So if we don't want that, we can still buy to close that option. So we would own the security. Our cost basis or risk exposure remains at 160.15 because that's the amount that we spent. But if we were to adjust the scenario and look at it from buying the stock at this time versus the assignment, we would absolutely be at more of a loss from owning the security outright than selling the puts. And so that's how selling puts can allow you to purchase it at a discount and reduce your exposure. So it's a really great example of that. If that one makes sense, I would love for you to put a 4 in the chat for me. Lots of 4s. Perfect. So let's talk about tips for finding yields. Number one, oftentimes, and this is applicable to trading or investing in general, if you never traded before, the first tip that is always given to you is to focus on stocks or securities that you're familiar with and comfortable investing in. So I teach options for a living and understand the market for a living. So therefore, there's a certain scenario that I'm constantly indulged in and embedded in. However, if you're in marketing or whatever industry you're in, you're going to have an edge on that specific industry. And so you're going to understand mechanics and what makes a good company better than someone else. Utilize your niche. That's so important when you're choosing a security or just stocks that you're generally familiar with and have an interest in and are comfortable investing in. That's a really great Warren Buffett rule, if you will, of doing your homework. So that's the point of showing you that is you focus on securities that you want to own, that you're familiar with, and you've done your homework with, if you're not so familiar with. 2 is the purpose of this is increasing income. So that screener that's built, or that opportunity report, you can sort it from every column that's listed. So choose the heading that focuses on raw return, because that's going to give you the highest yield. And then you can look at the security from there. So that's a great starting point to confirm. And I'll show you how you can pull that into the tool and look at risk versus reward, because that's really the key to mindset is risk versus reward. And we'll talk about that on a later session. If you have a small account and are looking to grow it, because essentially you're buying securities with this strategy, but you are buying them at a discount, you can still sort by lower price securities. So if you find a security that costs $20 per share, that's certainly going to require less capital than something that is 160 or higher. And earnings. This is really important, and we talked about it when we discussed pricing. Earnings does absolutely spike a premium, and it makes options more expensive, but it does make the security go up or down in value really drastically. So if that's something you don't want to participate in or cannot handle the emotion of that large movement, just avoid it. And that's why that's there. More important on the covered call side with the previous session, because remember, this is a strategy on stocks that we want to own, but we do not own yet. Therefore, earnings may be helpful, but if you want to avoid those, it's important to be cognizant of that. And then I put together just utilizing a cash covered puts to buy securities, a what and when, if you will. So the setup and closing out and some best practices. So this is a really great one page on the purpose of this strategy. So first and foremost, what and when. So this is the definition of it. Your view is you are neutral short term, because remember, a short put profits as long as the underlying security just remains directly above your strike price. But we want to participate in that capital appreciation long term, which means long term, this is a security I want to own and I am extremely bullish on. So that's your view, short term neutral, long term bullish. You have the cash readily available. So therefore, you have all of the requirements and the options level to execute upon this strategy. So your trade is selling a put, obligating you to buy the security at that strike price. And remember, you don't participate in rallies above your strike price premium. So just another way of the same concepts that we've been going through. And this does reduce your risk exposure. So this is when and what upon execution. To set it up, optimal expiration is 30 to 45 days. We talked about strike selection, so slightly out the money or at the money. So out of the money means does not have executable value, which means you're allowing yourself some room for the security to go a little lower before your execution obligation kicks in. At the money means market equivalent price. So if it's at, this one's at 165, the market's at 165, that's at the money. And those have a 50 delta. Out of the money will have a lower delta. And that makes sense because a lower delta means more likely to expire worthless. And if it's farther away from executable value, that likelihood of expiring worthless higher. An expert tip here is IV percentile. So that is something that's on the short put report. We talked about implied volatility just for a brief moment. What's important to know is there are some securities that have a very high implied volatility by nature. A US security that immediately comes to mind every time I talk about that is Tesla. Tesla, someone will tweet and it will move up in value, or it moves a lot. So it always has a high implied volatility. That's why an IV percentile is created. It's a range. So 50 just means normal. So if it's higher than 50, it has a higher than normal IV percentile. Therefore, it's an optimal selling environment. This is an example of what that would look like. Your obligation max loss and what I like to call the risk-free range, which is your rally point and your break-even point here. And we just, to make the math easy on myself, adding fives. Closing out. So this is really important. Whenever you are trading in general, and even for those with utilizing options from a long-term perspective, you want to take profit unless you immediately want to be assigned at 75% of premium, because maybe that's the point where we want to roll in that scenario, which we talked about earlier. From taking a loss, we want 100% of premium, or we allow assignment if bullish. But remember, if a security is moving drastically against us, so in this case, well below our strike price, that means we were incorrect in our sentiment, which will happen from time to time, but we're going to structure our trades with the appropriate risk versus reward so that doesn't hurt us in the long run. But if that happens, we must reevaluate, because even if you are making any financial decision, I love to use the analogy of buying a house, a car, a watch, a purse, or something like that, you're going to do a lot of research. You are going to understand if that's a place you want to live. You're going to make sure that you can afford it. It fits into your budget. Lots of reasons. The same equates to you doing your homework when you're investing. Dollars are still involved. So you're just not getting a tangible asset in the end. Consider rolling in these scenarios when it's 14 to 21 days until expiration, and that takes into account that theta decay. And if that rallies above our premium plus our strike price, remember, it's going to go down in value if it rallies above. So therefore, when it hits that price, we could adjust our price up higher and continue to collect premiums. And so that's a good consideration to roll in that moment. And then here are all the math equated with the above. So if that makes sense, you put 5 in the chat window form. Lots of 5s. Thank you kindly. All right. So this is the part where I'll leave it open for questions, and I'll also bring up the options play tool just so you can see how you can utilize that as well. If you have any chat questions, please feel free to type them into that chat window or the Q&A window. I have both open and I'm happy to answer them for you. All right, and then I'm going to show real quickly how to just utilize a short put within the tool. That's extremely important. There we go. And Andreas, I am happy to answer your question. Option contracts always in batches of 100 shares, no matter the share price. When they're not always, or that's almost a trick question. They normally are, though. One contract represents normally 100 shares. Yes, there are other type of contracts out there that don't have a lot of volume, so that have represent 1 share. Even those are called nanos. It's actually a newer product that the SIBO has offered. But generally, the most widely used are 100, unless otherwise indicated. Sometimes a contract can get adjusted. So if you have a corporate action of some sort, your contract has to adjust as well. And it adjusts to an equivalent of what would happen if you owned 100 shares. So if you thinking about the eBay PayPal spinoff, when that occurred and you owned 100 shares of eBay, you were also entitled to, I think, 20 shares of PayPal. Therefore, the contracts were worth additional 20 shares of PayPal, inclusive of the 100. But those are one-off circumstances. So it's always 100 shares. Are there any other questions before I go through the platform there? Of course. All right, so I'll give you just a quick little demo of what's here. And this is going back to the way that I love to think of data consumption. There's a much better way to consume data now than previously. So the first thing is when we're trading options is we want an idea, we need to know an underlying security. I showed you the report where we can pull optimal trade ideas based on the contract. But if you're trying to consider or think of a security, then there's also this watch list and trade ideas that are built for you as well. We try to make it as easy as possible. Red just means bearish, yellow, neutral, green, bullish. So that's an indication of trend. And then strength, that's the relative strength goes from 0 to 10. So something with a 10 is going to be extremely bullish. So you're not going to see something that is bearish with a 10, because that doesn't work. It's more of a range of 0 to 10 from a scale of bearish to bullish. So on the 10, this is extremely bullish because the relative strength is 10, whereas something that's extremely bearish would have a relative strength of 1. So that's important to know. So I pulled this security off of a watch list. You can filter this, you can make your own, but that's where I got this security from. Then when you filter on this security based on a technical basis, so this is something I want to own, this is where we give you as much information as we can that you need to make and validate that decision. So that's the purpose of this is my validation. So things like earnings per share, its range, dividend yield, which is important if we're trying to maximize yield. So remember, if I own an options contract, I don't have any rights to the dividend because I don't own the shares. You're not a shareholder. You may have the right to buy the shares or the obligation to buy a share in the case of a short put. However, you do not have those rights. So that's why another reason to maximize income is we want to own the security. And that's why I would choose that at the money option in this case, which is equivalent to the underlying price. This here is just some technical analysis. You can add indicators. This is the 1-month trend and the 6-month trend. So like I was talking about earlier, if the 1-month trend is bullish, and you see here how it was, the 6-month trend was neutral, indicated by yellow, but then switches to bullish, that indicates strength of the trend. And so that gives me an indication perhaps this is turning higher. And then you, of course, can add other technical analysis and indicators by clicking this button and adjust the charts around and drawings, a lot that this does, but just give you the high level overview. And then some price action as well. So anything crossing above its 200-day moving average is extremely bullish, especially right now. So that's certainly a help. And you can add those indicators. So this gives us an idea of the what. We validate, I'm bullish, I agree with this from a technical perspective, and the fundamentals that are displayed in me. This will default to bullish, but you can adjust to bearish or high implied volatility. So in this case, we were looking at high implied volatility and just a short put. So what I would do is you can modify these. And this is where we can compare and contrast the type of puts that we want. So I'm going to click the modify button. I'm going to remove this buy put and just concentrate on the short put. So the put that I pulled within this presentation was let's look at a 30-day, and we'll do, actually I was pulling the optimal there, but I'm going to switch it to 30-day. Maybe we'll do 52 actually. And let's do at the money, which is a 150. So that's 690. You may want to use the midpoint because options have a bid and ask, and that's the ask price is where we buy, the bid price is where we sell. We can get better execution using limit orders, sometimes around the midpoint. So I always switch that to the midpoint. That's the purpose of that. So now we can look at how much premium we will receive in what time frame. And we can click this button to give us the risk versus reward. So if you just click on the box, it changes. And then we can do the same here if we want to adjust. So I may want to modify this And again, perhaps I want to look at the same strike. So we've got the same exact security, but I want to look at the difference of just going back, or as in shorting my time frame. And I can also do the same here. Let's modify this. I want to switch it to a put, and we'll get rid of this. And maybe I want to give myself some wiggle room and look at that 30-day time frame and go to a 147.5. And we also have those deltas here. So this is a better way of visualizing that option chain. So these are the deltas, and then also a standard deviation to give you an idea of a standard movement for that security. So now what I've done is I have adjusted all of these, and now I can compare and contrast and understand which one is better. So now I'm going back to P&L Simulator, and I think this is a great way to just think about time and the impact that the security has. This options play score is utilizing all of these data points to prioritize risk versus reward. So purely by options play methodology, it's actually telling me to utilize this one. But you can make your decision from there. The purpose is just to give you as much information as possible. So now I can add my price target and see what would happen, by what date, and if implied volatility moves. And you'll notice that how these move if I'm very, very wrong, or my max losses. So this is a great way just to understand what happens in various scenarios. I like to use this as an education tool. And once I choose my chosen security or my chosen strategy, perhaps I'll go with this one. If you click this button, we have even more information. We'll give you an explanation of the Greeks and what that means. And then when you're ready to trade it, you just hit trade, and then all of the information that you need is available. So you want to make sure you utilize your tools that are available to you. And that was the purpose of options play, is there's no other platform that allows you to compare strategies together. And when this was built, the founders found themselves going between options chains and profit and loss calculators. So why not just put them together? Great. So that is it for today's session. I will leave a couple more moments for any other questions if you want to put those in the chat. I do encourage you to attend the next section. This is when we're going to talk about directional trading. So the buy side, we've covered short calls and short puts from the bullish perspective and maximizing yield and income to your portfolio. Tidbit of information. Again, I've been trading options for a while. A lot of people start with long calls and puts and then graduate to this, which we started with. So we wanted to make sure that we get we show you the yield perspective before we shift into the other, which tends to pique people's interest more. But I really hope you enjoyed this session. We certainly value feedback. So any feedback, please feel free to reach out. You can utilize this platform to send feedback, or info@optionsplay.com. We'll send questions directly to us as well. I appreciate your attendance today, and I hope everybody enjoys the rest of their week and has a wonderful evening.